There are moments in business history that make the entire world stop and ask, what the hell is going on? Rockefeller's oil empire did that once, Microsoft did it, Apple did it too. And now, Nvidia is doing the same thing. Just a few years ago, most people still thought Nvidia was simply a company that made graphics cards for gamers, the kind of company tech-obsessed teenagers would dream about every Christmas. But today, Nvidia has become one of the most valuable companies on the planet. At one point, its market value even surpassed giants like Apple and Microsoft. And the strangest part is this: most people still believe Nvidia is making its money from the gaming market. What they do not realize is that somewhere along that value chain, Nvidia is the one collecting the money. They are not simply selling chips. They are selling speed and time. And in the age of AI, time may be the most expensive resource on the planet. So how did a company once famous for serving gamers transform into the fastest wealth-generating machine in the corporate world? The answer may shock you, because that success came from a decision that nearly destroyed Nvidia at the time. And in this video, we will dig into every corner of the story to uncover the money-printing machine hidden behind Nvidia's extraordinarily rapid rise to success. If you look at Nvidia today, it's easy to think that its success was a smooth, uninterrupted journey. But the actual history was completely different. There were at least two moments in the company's history when investors believed Nvidia was headed for bankruptcy. The most dangerous one occurred in 2008. At that time, Nvidia had just gone through nearly a decade of strong growth driven by the gaming market. Its GeForce product lines had helped the company become a household name in the PC world, and Jensen Huang was widely regarded as one of Silicon Valley's most successful CEOs. Then everything changed. In September 2008, the investment bank Lehman Brothers collapsed. The global financial crisis erupted. In just a few months, trillions of dollars in market capitalization were wiped from the US stock market. But for Nvidia, the crisis was even more severe. At the same time, the company discovered a serious technical defect affecting multiple lines of GPUs and laptop chipsets. The chips developed internal connection cracks after a period of use, causing computers to freeze, display black screens, or fail completely. Major manufacturers such as HP and Dell were affected. Nvidia was forced to record hundreds of millions of dollars in charges to deal with the consequences. The market reacted immediately. Investors rushed to sell, and confidence collapsed. From its peak in 2007 to the bottom of the crisis, Nvidia's stock lost nearly 80% of its value. While Nvidia was struggling with serious mistakes, Intel dominated the CPU market. AMD remained its direct competitor in graphics. Many believed that Nvidia would eventually be swallowed up entirely, but the most remarkable developments were taking place inside the company's boardroom. Instead of focusing all its efforts on rescuing the stock price or cutting long-term projects, Jensen Huang continued to defend a program that had consumed Nvidia's resources for years. Its name was CUDA. CUDA was introduced in 2006. Its ideas sounded fairly simple: transform the GPU from a chip dedicated to graphics processing into a general-purpose processor capable of solving scientific, engineering, and artificial intelligence problems. Today, that may sound obvious, but in 2006, the idea had almost no market. Most customers bought GPUs only for gaming. Data centers did not yet need GPUs. ChatGPT was still nearly 2 decades away, and companies like OpenAI had not even been founded yet. That was precisely the problem. Nvidia was spending billions of dollars developing an ecosystem that had virtually no paying customers to use it. In the short term, CUDA increased product development costs and engineering expenses without generating proportional revenue. Many investors believed this was an irrational decision for a company that had just gone through a crisis. But Jensen Huang was looking beyond the battle of the next quarter or even the next year. He believed that the computing industry was approaching a new limit. CPUs were becoming increasingly difficult to improve in performance through traditional methods. Meanwhile, the amount of data generated by the world was growing exponentially. If the future belonged to massive computational problems, then the world would need an entirely different processing architecture. And if that day truly came, Nvidia didn't want to just sell the chip. They wanted to own the entire platform that developers would be forced to use. It was an incredibly risky bet, because in the late 2000s, nobody knew whether that future would ever materialize. So what exactly made Nvidia rich so quickly? The short answer is, Nvidia didn't make money by selling more chips than its competitors. They made money by making the entire technology industry unable to operate efficiently without their chips. That is a massive difference. In the semiconductor industry, building a powerful chip is not particularly extraordinary. AMD can build GPUs, Intel can build GPUs, Google can design its own TPUs, and Amazon has its own AI chips as well. If you look only at the hardware, Nvidia does not have a monopoly. So why do most of the world's leading AI companies continue to buy Nvidia products? Because what they truly depend on is not the chip itself, it is CUDA. This is the point that many investors miss. They see Nvidia as a hardware company, when in reality, Nvidia operates more like a platform company. Imagine that Microsoft never sold Windows, yet businesses all over the world built their entire systems on Windows. That is exactly the position CUDA holds in the AI industry. After nearly 2 decades of development, CUDA has become the familiar language of millions of engineers, the most popular AI libraries, the largest model training tools, most modern machine learning research. All are optimized for CUDA first. This creates an extraordinarily powerful network effect. The more people use CUDA, CUDA, the more tools are built for CUDA. The more tools are built for CUDA, the harder it becomes to leave CUDA behind. This is the very economic moat that Warren Buffett often talks about, and it is also why Nvidia hardly has to compete in the conventional sense. But owning CUDA alone was not enough to build a trillion-dollar empire. What Nvidia truly needed was an explosion in demand. That explosion arrived in late 2022 when ChatGPT was launched. This was the moment when the entire technology industry simultaneously realized a fundamental truth. AI was no longer a research project. AI had become a race for survival. Microsoft, Google, Meta, and Amazon rushed to invest. Every company shared the same goal: to build AI models that were larger, smarter, and faster than their competitors. The problem is that AI consumes computing power on a scale never before seen in history. A large language model may require tens of thousands of GPUs running continuously for months, and most of those GPUs are made by Nvidia. That was the moment Nvidia transitioned from a technology supplier into the company collecting fees from the entire AI boom. If the AI race is like a gold rush, then OpenAI, Google, and Meta are the gold prospectors. Nvidia, meanwhile, is the only store selling picks, shovels, and excavators to everyone. That is why Nvidia's revenue grew from about $27 billion in fiscal year 2023 to more than $130 billion just 3 years later. Not because it sold more consumer products, but because the entire technology industry was paying Nvidia to provide the computing power needed to compete with one another. And when every competitor is forced to buy from the same supplier, the rate at which that supplier accumulates wealth becomes extraordinary. But there is another factor that is often overlooked. It does not generate revenue or profit, yet it helped push Nvidia's market capitalization to historic milestones. That was the 10-for-1 stock split in June 2024. From an economic standpoint, a stock split does not make Nvidia richer. If you own a pizza and cut it into 10 slices instead of leaving it as one large piece, the amount of pizza you own remains exactly the same. Stock splits work in much the same way. The price of each share drops to about 1/10 of its previous level, but the company's total value remains unchanged. However, the stock market is not driven by mathematics alone. It is also driven by psychology, and the timing of Nvidia's stock split was almost perfect. In June 2024, the AI boom was at its peak. Institutional investment funds were continuously increasing their Nvidia holdings. Retail investors around the world all wanted to own shares in the company leading the AI race. When a stock trades at more than $1,000 per share before a split, many retail investors perceive it as psychologically expensive, even though they can, in fact, buy fractional shares. After the 10-for-1 stock split, the nominal share price dropped dramatically. Suddenly, Nvidia appeared more affordable to millions of investors. This created a very interesting effect. CUDA made Nvidia the industry standard for AI. AI generated unprecedented demand for GPUs, and the stock split helped open the door for a new wave of investment capital to join that story. In other words, if CUDA was the foundation and AI was the engine, then Nvidia's 2024 stock split was the psychological catalyst that helped the Nvidia frenzy spread from the data centers of Silicon Valley to the brokerage accounts of millions of investors around the world. After the 2024 stock split, Nvidia not only became the world's most valuable company at multiple points in time, it also became the biggest debate on Wall Street. What is remarkable is that this debate is not about the quality of the business. Instead, it revolves around a simple question: is Nvidia being valued as the future of the technology industry, or is it being valued as a perfect future that can never actually happen? That is where Wall Street began to split into two camps, each with highly compelling arguments. First are the bulls, armed with numbers that are very real and difficult to dispute. In the fiscal year ending in January 2023, Nvidia reported approximately $27 billion in revenue. By the fiscal year ending in January 2025, revenue had surpassed $130 billion. In just 2 years, the company's revenue base expanded by nearly 5 times. During the same period, net income increased from approximately $4 billion to more than $70 billion. Few large-scale companies in modern history have grown at such a pace. But the bulls argue that the most astonishing part is not the current numbers. It is the scale of investment that is taking place. In January 2025, Meta Platforms announced plans to spend between $60 and $65 billion on AI infrastructure during the year. By early 2026, that figure was expected to continue rising. Microsoft announced tens of billions of dollars in investments in AI data centers. Alphabet significantly increased its infrastructure budget to support Gemini. Amazon continued expanding its AI capabilities on AWS. The combined AI infrastructure investment of the hyperscalers has now reached hundreds of billions of dollars per year. According to the bulls, this is similar to the railroad building era of the 19th century, or the construction of the internet in the 1990s. During those periods, the greatest value was not created by the end applications, but by the infrastructure itself. Their argument is very simple. If AI becomes the new infrastructure layer of the global economy, Nvidia owns the most critical component of that infrastructure layer. Just as no one can build a modern city without electricity, the bulls believe it would be extremely difficult to build advanced AI models without relying on Nvidia's ecosystem. However, what happens if customers stop buying Nvidia's products? The bears do not dispute Nvidia's growth. growth. Instead, they focus on the sustainability of that growth. When analyzing the company's financial statements, one reality becomes clear. Nvidia's revenue currently depends heavily on an extremely small group of customers. These are hyperscalers such as Microsoft, Amazon, Google, and Meta. These companies are spending tens of billions of US dollars on Nvidia chips, largely because of the fear of being left behind, FOMO, while their AI services themselves have not yet generated corresponding cash flows sufficient to offset those costs. And it is precisely these companies that are spending the majority of the money building AI data centers globally. That leads to an important question. Have these massive investments actually generated a proportional return on investment yet? Currently, many tech companies are still in a phase of investing far more than they are harvesting profits from generative AI. AI chatbots are attracting massive user bases, but direct revenue remains small compared to the scale of infrastructure investment. The bears argue that this is a familiar sign of a speculative technology cycle. They often point to a historical example, the tulip mania bubble. In March 2000, Cisco Systems became the most valuable company in the world, with a market capitalization of over 500 billion USD. The internet at that time was transforming everything, and Cisco was selling networking equipment for the entire internet infrastructure. However, Cisco's revenue and profits did not grow quickly enough to justify its peak valuation. As a result, after the dot-com bubble burst, Cisco's stock fell sharply and took many years to return to its previous levels. Returning to Nvidia, much of its current record-breaking revenue is driven by this cycle. What will happen when these big tech companies realize they have bought too many chips and begin cutting spending? Or when they start designing their own AI chips, such as Google's TPU or Microsoft's Maya? The result is probably something you could already guess after hearing Cisco's story. However, the bears are not proving that Nvidia will collapse like Cisco did. They are simply trying to warn that history might repeat itself. Will you be someone who gets ahead of the future, or a moth flying straight into the peak of the biggest financial bubble in history? Sounds pretty convincing, doesn't it? Based on your understanding, which side would you take? It seems the debate about Nvidia is still far from over. What makes the Nvidia story special is that both sides have real data to support their arguments, and that is often a sign of transformative, once-in-a-generation investments in financial market history. At present, Nvidia is sitting in a position that most companies in the world can only dream of. They control the most critical technology in the AI race, hold tens of billions of dollars in cash, continuously break records in revenue and profit, and have become one of the most influential companies in the global financial markets. But the most glorious moments in business history are often when the risks are highest. Because Nvidia's biggest challenge in the future may not come from AMD, Intel, or any competitor we know today. It may come from things that do not yet exist: a new technological breakthrough, a more efficient computing architecture than GPUs, or AI models that require far fewer resources than they do today. Or it could simply be their largest customers finding ways to reduce their dependence on Nvidia's ecosystem. The history of technology has repeatedly proven a harsh truth: dominance is never the final destination. That also explains why the world's best investors spend more time studying risks than opportunities. Because opportunities create profit, but risks determine whether that profit can endure over the long term. Perhaps the most valuable lesson from Nvidia's story is the power of seeing a trend before the rest of the world does. CUDA did not create value simply because it is a good technology. It created value because Nvidia persistently built it for many years before the market actually needed it. In business, the largest profits rarely belong to those who react the fastest. They belong to those who prepare the earliest. And that may be the reason Nvidia has become one of the most compelling case studies of the 21st century. Not because we already know what the future will look like, but because Nvidia's future is itself a major stress test for the future of AI. What about you? After all the data, arguments, and perspectives in this video, which side do you stand on? And more importantly, which brand or company do you want us to decode next? Leave the name of that company in the comments below. The next video will very likely begin with your suggestion. Bye.